In this video, you'll learn 10 investment tips that will kickstart your journey to success in your 20s. Most of you know that what you do in your 20s will either make or break your future. Some people party all day, others work and study hard. Some are couch surfing, while others are hustling for a better tomorrow. The lives each of these individuals will live in the near future will be vastly different. Some will live great lives with family and kids, and others will likely struggle their entire lives. So, which are you? Let's look at a couple of things you should do for a rich future. But before we get into it, kindly take a moment to like this video and subscribe if you are new to the channel. Now, let's dive right into it. Tip number 1, come up with a plan. Benjamin Franklin once said, "By failing to prepare, you are preparing to fail." You see, the number one step to achieving success is creating a plan. This plan acts as a roadmap, guiding you toward your desired destination. So, begin by outlining short-term and long-term goals, and come up with a timeline to accomplish them. While immediate action might not be necessary, having a plan serves as a reminder of your commitments and help in identifying priorities. Moreover, it allows you to gauge the resources required to execute your various strategies effectively. Once your goals are outlined, come up with a plan and also include a budget, because it's highly likely that your plan will need some money to get started, whatever that goal may be. So, in the budget, estimate the funds needed and likely daily expenses. Always remember that your plan doesn't have to be perfect. As life evolves, you can review and adapt your strategy accordingly. Tip number 2, make managing your debt your top priority. With the typical student graduating with around $25,000 in debt, many folks in their 20s often stress about how they'll get rid of this load. But this can be overcome by coming up with a smart investment plan that focuses on clearing your debt now and eventually gets you to a place where you have surplus cash to invest. Consider this about debt. Every dollar directed towards paying off debt could be utilized to further one of your other financial objectives. So, you need to find ways of reducing and managing your debt. But where do you start? Well, begin by tackling your bad debt first, typically those debts carrying interest rates of 8% or higher. Doing so will save you a ton of money in interest and fees and eventually frees up funds to invest. On top of that, clearing high interest debt increases your potential earnings and positions you to handle and manage good debts like mortgages in the future. Tip number 3, start your retirement savings today. You might wonder why it's essential to start saving for retirement in your 20s, especially if you're new to the job market and still managing student debt. Here's the simple answer. The more time your money has to grow, the greater its potential to accumulate wealth. For instance, if you invest the maximum annual amount of $6,500 in a Roth IRA from age 25 to 50, your initial investment of $162,500 could grow to over $900,000 based on the stock market's performance over the past 25 years. Now, 2 great ways to kickstart your retirement savings are through your employer's retirement plan or an IRA. A personal retirement plan, like an IRA, allows you to save up to $6,500 annually until age 50, with an additional $1,000 per year in contribution limits after that. Additionally, employer-sponsored retirement plans such as 401ks or 403bs are great options. If your employer offers matching contributions to your 401k, take advantage of this benefit. Some employers provide matching contributions to the money you put into your 401k, which can significantly boost your retirement savings. Here's how it works. Suppose your employer matches dollar for dollar up to 3% of your salary. If you contribute 1% of your salary, your employer matches that 1%. However, contributing 3% of your salary allows you to receive the full 3% match. So, make sure you contribute enough to obtain the full match your employer offers. Regardless of the account type you choose or the amount you can invest, saving what you can in your 20s allows you to leverage the power of compound interest for as long as possible during your working years. Tip number 4, have an emergency fund. Investing goes beyond buying stocks or setting up retirement accounts like an individual retirement account or enrolling in an employer's 401k. Like any major life decision, investing demands preparation for life's uncertainties. The U.S. Securities and Exchange Commission suggests taking specific steps with your finances before diving into investments, including establishing an emergency fund. To start, open a savings account earmarked as your emergency fund. Decide the amount you aim to maintain within it. This pool of funds serves as a safety net, ready to support you in case of unexpected financial crises, like sudden medical expenses or job loss. The ideal amount to keep in this fund is a personal decision influenced by various factors, such as your monthly expenses and your comfort level regarding the consistency and sustainability of your income. Reflecting on your budget and past expenses can guide you in determining how many months' worth of expenses to stash away in this emergency fund. Tip number 5, diversify your portfolio. When structuring your investment portfolio in your 20s, diversification is critical. This involves spreading your investments across different sectors to minimize risks. But to do this, you'll have to fully understand the risk levels associated with each investment type. The riskiest investments typically include individual stocks, relatively aggressive mutual funds, or ETFs in real estate. However, investments that are safe but still has risks are mutual funds or ETFs that track broad stock market indexes like the S&P 500, the NASDAQ 100, or the Dow Jones Industrial Average. And on the safer end are bonds and bond funds. Most investors achieve diversification by distributing their funds across several of these options. For instance, they might own a mix of individual stocks, mutual funds across various indexes and sectors, and a moderately conservative bond fund. The primary strategy here is to avoid concentrating all investments in one area. This way, if one incurs losses, your other assets will still strive. Tip number 6, skip the hype, don't blindly follow trends. Don't get caught up in the buzz. While meme stocks, cryptocurrency, and NFTs have grabbed attention lately, your investment portfolio might fare better if you steer clear of the hype. Just because something is popular doesn't mean it belongs as a significant part of your investments. Tip number 7, understand the risk or reward trade-off. Your 20s are a time for calculated risk, not reckless moves. As a young investor, you should be open to taking on some risk. But that doesn't mean you should dive headfirst and invest everything in high-risk stocks. It simply means you should take caution when considering riskier options. Understand that some investments have higher risk appetites than others, and various factors might lead to losses, and you should be comfortable with that. It's often said that the younger you are, the more risk you can handle with investments. While this holds some truth, it's not precisely true for everyone. Your risk tolerance, capacity, and willingness to endure potential losses in pursuit of higher returns play a crucial role. Younger folks typically have a lot less at stake compared to someone older, like a 38-year-old saving for a family home and with kids to take care of. Yet, if certain investments make you lose sleep because they don't match your risk tolerance, it's not worth it, regardless of age. If you find yourself in such a situation, you must make necessary adjustments to lower your exposure to such risks. And this brings us to the next crucial tip. Tip number 8, consider using a robo-advisor. Navigating through your 20s can be hectic. That's why you need to simplify your investments by leveraging robo-advisors, which offer an ideal way to learn about investing without manual stock selection. These platforms automate investment management, tailoring portfolios to match your goals and preferences. With minimal investment requirements and often low to no annual costs, you can contribute funds and let the robo-advisor handle the rest. Here's how they work. Robo-advisors streamline and automate investment planning by asking vital questions upfront about your age, investment aspirations, and retirement timeline, creating a portfolio tailored to your risk tolerance and goals. Many reputable robo-advisors charge modest fees, require low initial deposits, and handle portfolio rebalancing to align with your objectives. While using robo-advisors, consistency in investing is vital. Aim for regular contributions, ideally on a monthly basis. Even small, consistent investments can lead to significant savings over time, but if the robo-advisor path doesn't suit you, then consider. Tip number 9, work with a financial advisor. When starting your investment journey, there's no shame in asking for help. It's a reasonable thing to do. Consider turning to a more experienced family member or a financial advisor as your starting point. Doing this offers valuable guidance and opens opportunities for building a lasting relationship with a trusted expert. While flashy financial videos on platforms like TikTok might catch your eye, certified financial professionals often give the most reliable advice. Look for credentials such as the Certified Financial Planner designation from the CFP board, or ask for recommendations from friends and family when looking for advisors. Engaging a financial advisor might seem like a pricier option, but their expertise proves invaluable in directing you toward the right investment path. They'll collaborate with you to set goals, evaluate your risk tolerance, and identify brokerage accounts that align with your requirements. They also understand the daily market trends much better, so they can guide you accordingly. Now, if you want to get a free financial consultation and get expert advice on financial planning, retirement, and so on, head over to Money Pickle using my link in the description. moneypickle.com/practicalwisdom. And by the way, this is not sponsored. I just believe that a lot of you would benefit from the service they are offering. Plus, it's absolutely free. All you have to do is book a time on the calendar and you are all set. So do check them out. Lastly, tip number 10, increase your financial knowledge. Personal finance involves more than just money. While earning and saving are crucial for wealth accumulation, it's equally important to understand the fundamental financial principles and terms and know how to utilize them. Understanding the ins and outs of finances empowers you to make informed choices simply because you know the available options and their potential advantages. In fact, you clicking on this video demonstrates your interest in learning investment strategies that can improve your finances. And that's it. Let me know what option caught your eye, and please share your thoughts in the comments section below. With that said, until next time, have a great day.